So remember, it is return on investment. Part A of this example 1, they want us to calculate whether or not the new investment is attractive to the company as a whole. And I've given students 2 minutes to try it. I'm waiting for 2 more answers. 2 more answers for me to be able to do this question. Yep, one more. I can see 3 already are in. You want at least 4. Great, thank you very much. So I'm able to see these answers, like I can see here from Purity Kirui saying ROI is 16.4%, Jabir's 16.4%, but there is one thing that you greatest of them all, students of mine, are forgetting. One most important thing that all of us are forgetting. One most important thing where all of us would have lost a mark. So as I'm saying this, I'm trying to look around to see where there is anybody who will be able to post the correct answer. I can see one more answer has trickled in. So if you guys had really printed this book out, I would have wished that you underline, calculate whether or not the new investment is attractive. The key word here is new investment. And then, of course, you will be required here to remember that generally, to get ROI, how do we get ROI? To get ROI, generally, we take profits all over what is somebody capital employed. Profit over capital employed. Profit over capital employed times 100. And remember that if you're given an opportunity, what kind of profit are we looking at? If, for example, they give you like an income statement where you are able to see profit, for example, before interest and tax, we have here profit before whatever, before tax, profit over tax. If you're given a choice of profitability, here we normally prefer the profit before interest and what here, somebody? The profit before interest and taxation. Yes, thanks, Faith. The profit before interest and taxation. What basically we call the operating profit. What we call the operating what here profit. Who is able to remember the other name of capital employed? Is there anybody who is able to remember the other name of capital employed? Because these are things that normally confuse my students. Capital employed, anybody who is able to remember a name of capital employed, any other name of capital employed? Anybody? Net assets, thank you very much. Grace has remembered this, even Faith has remembered this, that capital employed, because you look at your past papers, capital employed is also known as net assets. Net assets is also known as net assets. Now, ladies and gentlemen, remember, in part A of this question, they are very categorical. They want us to measure the performance of the new investment. They don't want us to look at the whole. The performance of the new investment using ROI. So it is the new investment using ROI that they would want me to appraise. That they would want me to appraise. So is there anybody who is able, ladies and gentlemen, to get information about this new investment? Yes. Yes. So they're telling us that Vent Seals division is currently making a profit of 82 on an investment of 500,000. Kenya has a target return of 15%. The manager of Vent Seals is considering a new investment, which will require an investment of 100,000 additional and will generate additional profits of 17,000. So if I were you, I would have calculated ROI of this new investment alone, which will be 17,000 divided by 100,000 times 100 times 100 times 100. So somebody, of course, will be able to bear witness with us that this exactly will be equal to what here, somebody? 17%. You know, they want us to appraise the new investment independently. So, and of course, this 17% is more than the company's targeted, ROI. ROI, the hurdle rate, what we call the hurdle rate. Hurdle rate, which is the same as what here, somebody, the targeted rate. The targeted rate of return is 15%. Hurdle means ile mchezo ya kuruka nini kwa Kiswahili. Unajua ile mchezo ya kuruka. So hiyo ndio the minimum acceptable. So once umeruka juu, wewe unapita. Kama ni project ikiwa na a higher return, imeruka hiyo kizuizi. So in this case here, 17% is more than this targeted ROI, which they have mentioned here, is more than this targeted ROI, which they have mentioned here of 15%. So therefore, the project here will be attractive from the company's perspective. Therefore, the project is attractive. I'm so sure this one, all of us would have gotten this correctly. Yes, Karanja has already raised up his hand. Is it possible, Karanja, that you type, or would want me to unmute you to speak? Karanja is raising up his hand. Let me check whether he has a comment. Because if I unmute him, yeah. Reject new investment. Why are we rejecting? And yet, in this case here, the new investments, ladies and gentlemen, the new investments, unmute, okay. Yes, Karanja, the floor is yours now. I've given you the right to unmute yourself. So in this case here, unmute yourself and speak.
Okay, thank you, Mwalimu.
Yes.
I was asking because from the question here, I had calculated the way you have done it.
Mm-hmm.
And I got 17% return on investment.
Mm-hmm.
But now, after reading the question again, it is saying a new investment which require additional investment of $100,000.
Mm.
Are we not adding to the 500?
No.
Because it is additional.
Thank you. This concept of adding now will come in part B of the question. Part A of the question, they only want us to appraise the new investment independently. And for us to be able to understand this very well, Karanja, please allow me to look at part B. You'll be able to discern this better when we look at part B of this question. What is part B telling us? To calculate the ROI of the division with and without the new investment, and hence determine whether or not the manager will decide to accept the new investment. Calculate the ROI of the division with and without. If I'm the one doing this, first of all, I'll come and give them the ROI without the new investment. So I'll write there, ROI without the new investment. ROI without the new investment. So we have here ROI without the new investment. That is the current ROI. What we call the current ROI. What we call the current ROI. The current return on investment for the entire division. So it's very easy. You will take the division of profit all over the investment in the division. So in this case here, what have they told us? If you look at the question very well, they've told us here to calculate the ROI of the division without the new investment. So we are told here, the vent seal division is currently making a profit of 82,000. Currently making a profit of 82,000 on an investment of 500,000. So straight away, these divisions' return on investment will be the current profit over the current investment. So 82,000 divided by 500,000. So this will be 82,000 divided by 500,000 times 100. Could you kindly give me this answer? Kindly give me this answer. So ROI of the division without the new investment. (16.4%). 16.4%. Now from there, you'll come and now give us ROI of the division, with new investment. So with the new investment, what am I going to do? I'm going to retain my numerator here, 82,000 all over 500,000. But now remember, this time around, there is something additional that is coming. There is an additional profit over how much the new investment is giving us, a profit of 17,000. But remember, we have to inject in more capital. An additional capital of what here, somebody? Over 100,000. An additional capital of 100,000. So then this will be 82,000 plus 17,000 equals, divided by, please go ahead and of course divide the numerator with 600,000. So Karanja tells me that this is what here, somebody? 16.5%. Therefore, the division is better off with the new investment, since 16.5% is more than 16.4%, is more than 16.4 what year percent, is more than 16.4%. So you can see, ladies and gentlemen, that this new investment is coming to boost the ROI of the division. The ROI of the division. The 50% notwithstanding, when you have a new investment increasing the ROI of a particular division, then automatically that investment is good. That is an indication of what here? Better performance, an indication of better performance. So still, if you're together, Agetonga, could you kindly now again unmute yourself and address us? Are you able to see now the argument here? Because the first one, they spoke of the new investment alone. The new investment alone. And of course, you can also go to the back of that particular book. I gave you a very good way of checking. You can go to the back of that book. It has got answers. It has got answers. All right. Now, ladies and gentlemen, before I go to a comprehensive question of performance appraisal, I would wish you to straight away go and do this one here, example 2 yourselves, where they're telling us here that the circumstances are the same as in example 1, except that this time round, the manager of Ventspils division is considering an investment that has a cost of 100,000, that's an investment, and will give additional profit of 16,000. They want us to calculate whether or not the new investment is attractive to the whole company, right? And then B, calculate the ROI of the division with and without the new investment, and hence determine whether or not the manager would decide to accept the new investment. So I'm giving you that question. You try it. I'm giving you 2 minutes. You try that question. Okay, I can see answers are come on board. They've come on board. Very good. Very good. Very good. So please, when you're giving me answers, like mention part A. Part A, what is the answer? And then we go to part B. Part B, what is the answer? That is how I would want to see you guys giving me these particular parameters. So part A, I'm being told it's 16.4%, which I doubt, because part A, we are appraising the new investment alone, calculate whether or not the new investment is attractive to the company as a whole. So the company as a whole, I'll not go to look at the divisional performance. I'll only be looking at the entire division, what is happening there. I'll only be looking at the entire division, what is happening there. Entire division, or rather entire company, from the perspective of what year? From the perspective of the new investment. Perspective of the new investment. So perspective of the new investment, it is 16% yes. It is 16% yes. I like that. Don't lose out any mark there. These are low-hanging fruits. So what they're telling us, ladies and gentlemen, is this. What they're telling us, ladies and gentlemen, is that every other thing remains like we were told up there, except for the fact that we have a new project. This new project here, they would want me to calculate the ROI of the new project alone. New project alone. The ROI of the new project alone. So the new project alone, I take the profit of the new project, which is 16,000, all over the investment. How much are we pumping in? We are pumping in 100,000 times 100. This will give me 16 what year? 16%. So remember, the whole company has got its own hurdle rate, has got its own, in this case here, rate, which is using to either accept projects or reject them. So it has a hurdle rate of 15%. And this hurdle rate, you can see that the new investment here, the new investment ROI is more than 15%. Therefore, from the perspective of the whole company, we are better off in this case here, accept. So from the perspective of the whole company, which is appraising individual new projects separately, then automatically we shall come and do what you shall come and accept. Now from there we go to part B. Part B now they want the divisional performance. Divisional performance with and without. So divisional performance, come here and they give me the ROI in this case here of the division without the new investment. So without the new investment, they are given us in part one up there, they are given us a profit. Who is able to remember that profit? Who is able to remember that profit? Who is able to remember that profit? Somebody. Who is able to remember that profit? Somebody. Who is able to remember that profit? Somebody. The profit for the division, the profit for the 80,000, yes. So 80,000, you divide this by what here, somebody? You divide this by 500,000, which students are giving me a figure of what here, somebody? 16.4%. Is it 80 or 82? 82,000. They're reminding me it's 82,000. They're reminding me it's 82,000. And then come and give us straight away the ROI of these, in this case here, with the new investment. With the new investment. With the new investment. So the new investment being brought on board, it will be 82,000 plus what year? I see the new profit there is 16,000. All over 16,000. All over what year? Somebody all over 500,000 is the old investment plus the new investment here of 100,000. So then this will give us 16.3 what year percent, which from the perspective of the division, this is a declining ROE, a declining ROE, which signals what year? Poor performance, which signals poor performance, which in this case here will lead to rejection of new investment, by who? By the division. Of new investment by who? By the division. Of the new investment by the division. By the division. By the division. You're right. This thing fell down long time ago. Right. I hope now you're able to hear me very well. So you're saying that this ROE is what here is declining. And you yourself, when you will be hired as a CEO, ROE is amongst those metrics that you must always guard against declining. You must guard them from going down. Anytime you realize that there is any new project you're bringing on board, which takes down your ROE, then automatically you need to decline that. You need to reject, you need to reject it like that. So this one will be rejected. But now, okay, but now there is an issue here. What is the issue? The whole company is saying accept. The division is saying reject. Which decision do you think now will prevail at the end of the day? Which decision do you think will prevail at the end of the day? So in short, we are saying that there is what we call conclusion here, very important conclusion, that there is what we call, there is a goal incongruent. A goal incongruent. Incongruent. Goal incongruent. There is a goal what here? Incongruent. You know, when you talk of congruence, when there is goal congruence, it means that there is an agreement. Ladies and gentlemen, remember, at the end of the day, the whole organization would want what we call profit to be maximized. All of us are seeking profit maximization and would expect the divisions or departments of ours also to pursue the same objective, which is profit what here maximization, which is profit maximization. So when profits for the division, when the division is engaging in activities that will not maximize the overall profitability, then there is, in this case here, a disagreement in goals. Like now here, the whole company is saying, accept. For our profit here as a whole company to grow, accept. But the division in this case here is saying, no, reject. So in this case here, there is a disagreement in terms of goals. And a disagreement in terms of goals is what we call incongruence, not in agreement. And whenever goals are not in agreement, divisional goals and the company goals are not aligned, they are not in the same line, they're not moving parallel, then at the end of the day, it is the overall company's decision that will prevail. So in light of this incongruence, we are making a conclusion that in light of a congruence, we shall always pursue those decisions which maximize the overall profitability of the whole company, Unaambia division, we kataa, lakini kampuni imeamua. So unasema hapa in conclusion, there is goal incongruence. there is goal incongruence, goal incongruence, goal incongruence, and therefore, the decision of the whole company will prevail. And therefore, the decision of the whole company will prevail. i.e., the new investment will be, the new investment will be accepted. The new investment will be accepted. You can even see both of them are beyond the hurdle rate of 15%. They are more than the hurdle rate of 15%. All right, for us to be able to really cement this thing in our minds, I would want us to look at another example, a bit different though, but on the same line, which is here with us. Example 3. They want us to repeat examples 1 and 2, but in each case, assume that the manager is assessed on his residual income, and that therefore it is this that determines how he makes what year decisions. How he makes decisions. So the key word here is residual income. The key thing there is residual income. And I'm giving you, just as usual, just 1 minute to ensure that all of us are able to get these correctly, I'm so sure you guys must have watched that particular what year video where I had explained so nicely this concept of residual income. Okay. Oh, I can see so many responses. Thank you very much. Okay. Thank you very much. I can see Yetonga is really watching those videos. Yeah. So the first thing that you're supposed to know about this residual income, about the residual income, is this residual income. Residual income is among those concepts that I'll never get it wrong. Among those concepts that I'll never get it wrong, simply because of what here I know. Most of you guys love Coca-Cola. So we know that residual income equals profit minus coca. Profit minus coca. Yeah, profit minus coca. Profit minus coca. Profit minus Coca-Cola. Great. Now, ladies and gentlemen, in this case here, what do we have now? What do we have now here? I can see answers are coming in on board. First of all, I would want you to write there, COCA stands for cost of capital employed. Cost of capital employed. Cost of capital employed. So we start with example number 1 for that project, in this case here, that was giving us a return of 18,000. New project giving us a return of 18,000. So remember, the question is very clear. They've told us here, in each case, assume that the manager is assessed on his residual income. We go to example number 1. Example number 1, Acacia PLC has divisions throughout Baltic states. The Ventspils division is currently making a profit of 82,000 per annum on investment of 500,000. Acania has a target return of what year? 15%. The manager of Ventspils is considering a new investment which will require additional investment of 100,000 and will generate additional profit of 17,000 per annum. So I would want somebody here to help me in calculating the residual income. The residual income. Can somebody, in this case here, you mixed up these questions. Somebody calculate this residual income of example 1. Residual income of example 1. Very easy, you'll be surprised. Okay. So for part 1, if you wish, we have our profit. They have given us our profit of the new investment. The new investment, we are told, the additional profit, by the way, is 17. Right? So the first thing that I would want to do here, ladies and gentlemen, is to define my cost of capital. Please give me my cost of capital. In most cases, your examiner will tell you automatically that this is the cost of capital. In most cases, the examiner will mention it to you. But in the event he doesn't mention it to you, you are a scholar of advanced financial management. You know that cost of capital could also be known as what is the required rate of return. Required rate of return. So this required rate of return, is what they have given us as what here as 15%. The required rate of return is 15%. Is 15%. 15%. So then if you wish come and start by giving us a residual income of the new investment. Residual income of the new investment alone. New investment alone. So the residual income of the new investment alone, is there anybody who is able to see in number one what our profit is? In number one, what is our profit? Profit number one, profit of the new investment. Profit of the new investment is how much? Profit of the new investment is how much? Is 17,000. Minus the cost of capital. The cost of capital is 15% of the amount we are going to tie up in this new investment, 15% of the capital to be invested in the new investment. The capital to be invested in the new investment, ladies and gentlemen, you guys gave me what figure here, somebody? You gave me a figure of 100,000. You gave me a figure of 100,000, right? So in this case here, user is telling me that the residual income here, that this is 15. So 17,000 minus 15,000, that gives me exactly a residual income of what here? 2,000. Any project which has got some residual income, regardless of how small it is, that project is good. We only reject projects whose residual income is negative. We only reject projects whose residual income is negative. So 2,000 is positive. So in this case, ladies and gentlemen, from the perspective of the whole company, this project must be done what here? Must be accepted. Now, please go to the division. Please go to the division. And for division, first of all, I would want you to give me residual income for the current situation. The current situation without bringing in any other new investments. Residual income of the current situation. The current situation, what is the current profit that this particular division is making? This particular division is making how much? Juma tells me that it is 82,000 minus my Coca-Cola, oh my, 15% times the total investment of 500,000, 500,000. Which somebody is pointing out to a residual income of 7,000, residual income of 7,000. So then, ladies and gentlemen, could you kindly go ahead and give me the residual income of this division when we add the new investment with the new investment. So with the new investment, this is what is going to happen. My profit now will be 82,000 plus, was it not 17,000? The new project is bringing a new profit of an additional profit of 17,000 minus still the cost of capital will be 15% into the total investment. The total investment now will be 500,000. Remember, the investment going into the new project was 100,000. Was 100,000. So then, could you kindly give me the residual income now with this new investment? With the new investment, Veni Brianna tells me it will be 9,000. 9,000. So, what is your take on this new project? Is it good or bad? Is it good or bad? Is it good or bad? Good, because you can see, ladies and gentlemen, that the residual income is growing. And if you are keen enough, you must have discovered that our residual income has grown exactly by this amount. 7,000 to 9,000, that difference is 2,000. 2,000. And that is why we love residual income, because residual income, decisions are always congruent. Decisions are always what here? Congruent. They agree. So in this case, even without going into a lot of literature, tell us there straight away that the decision here should be to accept. The decision is to accept the new investment, to accept the new investment, since it leads to what here? Since it leads to additional residual income, since it leads to additional residual income of how much? Of 2,000. It leads to additional residual income of 2,000. it leads to additional residual income of 2,000. Thank you very much. Now, I would want you to do me a favor and look at May 2018, question number 5A. May 2018, question number 5A. We can just jump out of that. We go to May 2018, question number 5A. I will be a happy man. May 2018, question number 5A. Once you get, in this case here, that question, ladies and gentlemen, simply shout, yes, I have the question. Yes, Spirit says yes. Thank you very much. If you don't have it, also let us know that you don't have it by saying N, so they can know what to do for you. It's page number 180 of the book. Page number 180 of the book. If you don't have it, we can also screenshot it and send it to our WhatsApp group. But I don't see anybody really who is indicating anything of that nature. Thank you very much. Everybody has it. So we are told S Limited has two divisions, namely B and C, each under a new divisional manager. The two divisions plan to acquire some investments in the month of August 2018. The cost of capital for both divisions, as I told you, you can see most of these examiners will always give you the cost of capital. So the cost of capital for both divisions is 13%. The current return on investment of each division is 15%. The division's planned investment have the following features. You can see the capital required for investment for B and C. You can see revenue generated by investment is that. Net profit margin has been given to us. For each of the two divisions, compute ROI, compute return on investment. Let us first of all handle part one, where they want us to give them ROI, So I don't know whether you guys would want me to do the question directly or I give you like a minute, you look at it properly. What do you think should we do here? We try. Thank you very much, Ruth. Thank you very much. We are trying it. Thank you. Thank you, Doreen. Try. You guys need to start thanking me very soon. You can hear, because of our online classes, now that parents, mothers have more time with their kids, you can hear how kids are happy, right? The kids are happy and they are energetic. Yes. It's only one person I've seen giving me an answer. Two people now, two people now, two people now for B. Very good. Good. Those are kids who will grow knowing mwalimu wa baba, mwalimu wa mama. Very good. Very good. Very good. Those are future ambassadors of mine. This is the revolutionary thing with what here, the online classes that now, like now here I can see I have about 34 students who are online. I'm teaching more than 34 students. I'm teaching families. I'm teaching families. I'm so happy. At times call your kids, come and see our teacher. Yes, the only thing that I need to do now is to start wearing ties throughout, right? Ladies and gentlemen, the first thing that we ought to have done in this question is to do what? The first thing that we need to do in this question is to come and write the formula of ROI. So how do we get ROI? To get ROI, remember, is also known as who? Is also known as, there is a time I met some student somewhere who was calling this thing ROS. No, professionally, this is ROCE. That's how you pronounce this. It's ROCE, return on capital employed. Return on capital employed. And the return on capital employed, or rather ROE, will always be obtained by us taking the profit of the organization divided by what your net assets or capital employed. Now, this examiner tried to deny us the profit. Instead of giving us profit, he went ahead and gave us profit margin, but we are brighter than that. We know that profit margin, he gave us the profit margin. And we know that for us to get profit margin, we normally take the profit all over what here, somebody, all over sales. You know, we have got what we call profit margin, and then we have got profit what here? Profit markup. Profit margin and the profit markup. Profit margin and the profit markup. Now that he never gave us profit, we have got to look for it ourselves. So my profit here will end up giving me sales, if I make it the subject of the formula, times the margin, times the profit margin, right? So in this case here for profit over B, if you're so keen, you must have realized that B sales, they've given us sales of 450,000. 450,000. How about the profit margin for boy down there? It is 30%. 30%. So could you kindly give me this profit here that I'm looking for? Could you kindly give me the profit that I'm looking for? The profit that I'm looking for B. The profit for B. 135,000. Thank you very much. 135,000. Thank you very much. And then, ladies and gentlemen, now we have the profit for C. So the profit for C, what do we have? I can see I have the sales of C, 200. And you see, sales is the same as revenue. Sales is the same as revenue. Thank you very much. It is 210,000 times its margin. Margin of what here, somebody? Margin of 35%, which somebody tells me is giving them 73,500. Now with that, I'll be able to get now the ROEs very easily following this formula. So ROE of company B, of division B. So do I have the profit of B? Oh, yes, I do. Profit of B is 135,000. Do I have the capital employed of boy? Do I have the capital employed of boy? Yes, I can see on that table, note 3. The capital employed of boy is 800,000 of B, is 800,000 times 100. Could you kindly give me this answer? Kindly give me this answer. And I saw some students who got this right. 16.88%. That is the ROE of B. Thank you very much. And then we have the ROE of which company here? Of C. So C, fortunately, we have the profit of C as 73,500 all over the investment in C. The investment in C, which is also known as capital employed, I can see it's 400,000. Supposed to be 400,000 times 100. So this at the end of the day will give us what answer? This at the end of the day will give us what answer? 16.38, 16.38, are you sure? 16.38, 18.38, 18.38. So of course, here they never asked us to make any comment, but as a good scholar, you know that these are performance appraisal measures. So if I were you in an exam situation, I would have said that C, division C, posted a better performance than division what here? B. Division C posted a better performance than division B. Why? Because we appreciate the fact that the higher the ROE, the better the performance. 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 Now, from ladies and gentlemen, I would want us also to try Roman 2. Let's try Roman 2 ourselves. Roman 2 is about residual income. Mm-hmm. I'm not seeing comments. I'm not seeing comments. I'm not seeing comments. Yes, yes, yes. This is quite easy, quite easy, quite easy. Why? Because already they have given me, they've given me everything. The thing that I need here is the cost of capital, And then I remember that residual income is a coca thing, So what I need to do is to come here and remember that to get residual income, what I need to do is to come and take the profit minus Coca-Cola, minus cost of capital employed. So I'll come and start with B. So B, am I able to see the profit of B? Oh, yes. The profit of B is 135,000. Minus cost of capital employed. Yes, I know that the cost of capital employed is given in note 1, which is 13%. So 13% of the total capital that was employed. Total capital employed in B is 800,000. So could you kindly give me these answers? People are giving me 31,000. And then now we have C whose profit here is 73,500 minus the cost of capital normally cuts across. Cuts across 13%. So 13% of what here? Of 400,000. 13% of 400,000, which at the end of the day will give us, Joyce, this is which question? Joyce, this is May 2018, question number 5. Thank you very much. Yes. May 2018, question number 5. So what do we have there at the end of the day? People are giving me answer. Which answer? For C, 21,500. 21,500. So again, in terms of performance, ladies and gentlemen, of course, in terms of performance, the higher also the residual income, the better. Yours basically is to comment that in terms of residual income, it is B, which performed what here? Which performed better. In terms of residual income, it is B that performed better. So I don't know whether that is okay, ladies and gentlemen. Great. Now, if you allow me, I would want us to move straight away. To this question that keeps on coming every other semester. November 2018, question number 4A. November 2018, question number 4A. November 2018, question number 4A. It's about the balance scorecard. If you remember very well, there is a time I spoke about balance scorecard. If you remember very well, we say that a balance scorecard looks at the performance of an entity from how many perspectives? 4 perspectives. 4. So we have what we call the financial perspective. We have the customer perspective. We have, in this case here, the processes perspective. Internal processes perspective. And then we have lastly, learning and what here? Learning and innovation. Basically what we call the growth perspective. Yes. So the question here is, I can see some comments here. Page number, yes. Page number, it's page number 177. Page number 177. So, MWL Limited has in the past produced just one fairly successful product. However, a new version of this product has recently been launched. In the meantime, development works continue with the aim of adding related products to the portfolio of products. So given below are some details of the activities carried out during the month of October 2018. So I can see units produced, existing product 25,000. And then the new product they produced 5,000, quite a good company. Production cost, I can see the existing product 375,000. I can see the new product there 70,000. Sales revenue, I can see sales revenue there, right? I can see hours worked. I can see development cost. So they want me to compute the performance indicators that could be used for each of the 4 perspectives on the balance scorecard. On the balance scorecard, I would want to give you exactly 5 minutes. 5 minutes. You try telling me, they don't even want you to discuss anything. They simply want you to calculate metrics, which from the information given will be very important for us when we are appraising learning and innovation, when we are appraising processes, when we are appraising customer perspective, and then of course, when appraising the financial perspective. I would want to see whether there is anybody who will be able to get this in 5 minutes. Please remember, this is supposed to be a very good class. Yeah, I like where I work. I normally see people, even when they are receiving calls, they like moving around. Don't just sit, no. At times you wake up a little bit, walk around, come back to desktop, etc. And then you reason better, you reason better. So 5 minutes, great. I'm not seeing any answers. I'm not seeing any answers. I'm not seeing any answers whatsoever. So I'll start with the low-hanging fruit. The low-hanging fruit here would have been the development cost. I would be interested in knowing the percentage of this development cost in terms of what year? The sales of the business. Because a good business should be able to score very well in terms of research and development. I would want to see a company whose research and development budget increases year by year. And of course, development costs, I'll come and book this in terms of what year, under which perspective, under the innovation. When you keep on developing, researching on more products here and there, then automatically you will become very innovative. So under research and development here, I look at the development cost. So they have incurred 47,000, they have incurred 47,000 development cost. I'll book this under learning and innovation. You can even have them as headlines, headings. So this is 47,000 divided by the total sales. You don't discriminate. 47,000 divided by the total sales. I know you guys are great. So total sales there is 550,000 plus 125,000. Total sales for both old and the new times 100. And then of course I'll go and compare these development cost percentage to the industry benchmarks. The industry benchmarks. So can somebody give me this at the end of the day? What figure are we getting here? $6.96%. Yeah. So I'll not be able to make any comment, of course, because I don't know what other companies in the same industry are incurring, but at least I know that this company is striving to progress, and that is why they are able to develop new products. Now, the other low-hanging fruit that I would have picked very fast, which I can come and have a heading for it, because this space, if I do this will not make a lot of sense, is the financial perspective. Financial perspective, and the financial perspective, we were able to see the ROEs, the residual incomes, the better, but here, the only thing that I'll be able to pick out very easily is the gross profit. Gross profit. So I would want someone to give me the gross profit for the old, gross profit for the existing products. Gross profit for the existing products. Can someone tell me I should take what minus what? The gross profit. So gross profit, of course, I can see sales there, 550,000. 550,000 for the existing product sales minus the production cost. Production cost of how much here? Somebody, production cost of the existing product is 375,000. So could you kindly give me this answer? Gross profit of the existing product. I'm waiting for that answer. 375,000? No, no, no. You have not calculated this very well. No, I want the gross profit of the existing product. So I've taken sales revenue of 550,000 minus production cost of 375,000. What is that difference, somebody? 125,000. 175,000. This is 175,000. Thank you. How about the gross profit of the new product? of new product. Gross profit of the new products. So we'll take the sales revenue of 125,000. I subtract the production cost of the new products, 70,000. 70,000. Could you kindly give me this? $55,000. Thank you, and thank you very much. Of course, the way they are, these figures here may not make a lot of sense to us. We would want to convert these to percentages. So I would want someone to come and give me the gross profit margin of existing products. Of existing products. Gross profit margin of existing products. I know you guys know the formula. It is gross profit over sales. It is gross profit over sales. Gross profit over sales. So for the existing products, gross profit is 175,000 divided by the sales of the existing product. The sales of the existing product is 550,000 times 100. So could you kindly give me an answer at the end of the day? What figures are we going to get? Gross profit margin of the existing products is 31.82%. These are some of the metrics I'll be interested in. How about the gross profit margin of the new products? Gross profit margin of the new products. I'll take the gross profit here of the new products, which is 55,000, I mean, all over the total sales of the new product, which is 125,000. Which I'm being told here is 44,000, 44%, sorry, 44%. Thank you. Thank you very much. And again, remember, in such a question, there is no hard rule. Someone else would have even gone ahead and calculated for us the gross profit of the entire, gross profit margin of the entire company. We will have taken the two profits here together, divided by what is somebody the total sales. Still, that is a measure. It's a measure. It's a measure, right? Somebody could have decided to get the gross profit of the existing products alone, and then now gross profit of the two products put together, right? So there is no hard rule, no hard rule, no hard rule for this. Whatever you write down, so long as it makes sense, so long as it's a metric which will be able to help us basically pick between, for example, two companies to say this company is doing much better than the other, no problem, like that. Great. Thank you very much. Like now here I can see in terms of GPM, the new product is doing very well. The new product is doing very well. The new product is doing very well. Now, so remember, I'm not supposed to do any comments. The question is very clear. They only wanted us to calculate the metrics which you could use in the various in the various perspectives of the balance scorecard. So how about the internal processes perspective? Internal processes perspective. Very easy, really. Here, I would want to see whether I have improved in terms of what here? Efficiency. So it is the processes perspective, remember, processes perspective. So I would want to see whether I have improved in terms of efficiency. I can only say, ladies and gentlemen, that I've improved in terms of efficiency if, for example, my production cost is reducing. If my production cost is reducing with the time. So for instance, here I'll come and give them the production cost per unit. This is quite a good measure. Production cost per unit is a good measure for the existing products. For the existing products. And then production cost per unit. Production cost per unit of the new products. So that I can see whether I'm making progress with the time. So fortunately, they have given me the production cost. They've told me the production cost is 375,000 for the existing. So 375,000 divided by number of units to get per unit. So 375,000 divided by how many units, somebody if you're following? 375,000 divided by how many units if you're following? Please talk to me. Divided by the existing product units, yes, which are 25,000. Could you kindly give me this answer? Kindly give me this answer. 15. Thank you very much. So how about the new products? I'll take the production cost of the new product, production cost of the new product. Production cost of the new product, what do I have? I have 70,000 divided by 70,000 divided by 70,000 divided by 5,000. Who is able to give me this figure? 14. 14. Are you seeing some improvement? Yes, I'm becoming more efficient with my production. I'm becoming more efficient with my production. I can also want to come and, for example, measure my systems in terms of labor. In terms of labor. So still under the processes perspective, under the internal processes perspective, ladies and gentlemen, I can come and give them the production per hour, production quantity per hour, still under the processes perspective. Processes perspective, I'll be able to give them the production quantity per hour, per labor hour. So we start with the existing. So existing, then I'll take what divided by what, because I would want to see whether I'm able to churn out more products here every hour, more products every hour, every hour. So existing, I can see the production quantity was 25,000. 25,000, 25,000 divided by the existing hours there, existing product hours, which are 5,000. 5,000. Can you kindly give me this figure? This must be 5. 5 units. 5 units per hour, 5 units per hour, 5 units per hour, 5 units per hour, 5 units per hour. Is that okay? Yes. How about in this case here for the new products? Am I able to produce them much faster? If I'm able to produce them much faster, then that automatically will be a signal that my systems are becoming more efficient. My systems are becoming more efficient. So for the new products, what do I have here? For the new products, what I have, ladies and gentlemen, we produced 5,000 in 1250. So 5,000 divided by 1250 hours. Will you kindly give me that? I'm looking for quantity per hour. Somebody gives me what here? Somebody 4 units per hour. 4 units per hour. Which really doesn't augur very well for me because I produced fewer. So it means that there is a problem with my productivity rate per hour. I produced much less for each hour in comparison to what I had done with my existing products. So then that is okay. So how about the customer perspective? Customer perspective, remember we are looking at acquisition of customers, satisfaction of customers. Those are the kind of things we're looking at. But here, of course, they haven't really given us those metrics. So they would want us, ladies and gentlemen, they would want us, ladies and gentlemen, to give them, they would want us, ladies and gentlemen, to give them some important metric here under the customer. Customers, of course, the best also way of measuring this is the growth in terms of revenue. Revenue coming from new products, right? Whether in this case here, at the end of the day, our revenue was growing or not. So I would want to give you 1 minute. You try this out for me, the customer perspective. Are we growing or not? Okay, in the interest of time, I can see we have very few minutes. Remember, if it's, for example, my college here where I'm looking at the customers that I've acquired, the students I've acquired. What I'll do, I'll look at the new students that I have in a semester out of the total population. So the same case here, in terms of customers growth base, I will look at the new sales here out of the total sales times 100. So the new sales revenue, are you able to see the new sales revenue is how much? Somebody? The new sales revenue, is anybody who is able to see how much that is? The new sales revenue is 125,000 out of not the old sales alone, out of the total, add the two. So out of 125,000 plus the old was 550, if I'm not wrong, plus the old was 550. The old was 550, if I'm not wrong, the old was 550. The old was 550. In terms of revenue. Thank you very much. So then times 100, what percentage are we getting, somebody? So then when I do this, I will be able now to compare this with the industry averages. I'll be able to compare this with the industry averages. I will be able to compare this with, for example, previous year's metrics to see whether we are growing or not, and that is it. Read the question again. Required, compute the performance indicators. What some literature will be calling the key performance indicators. The key performance indicators. So they never wanted us even to comment at all, just the performance indicators. So I would want at your own time, and this is something I would want to see you guys doing so seriously and posting it on our WhatsApp group. This May 2019 question 5A. May 2019 question number 5A. I would want you to try that question and then you post it. You post it and then you post it. You post it. You post it. Great. So thank you very much, ladies and gentlemen. It has been a pleasure hosting you tonight.